We're coming now to our third and last, but not least, panel for the day on emerging risks and macroprudential policy, which will be chaired by Thorsten Beck, professor at the European University Institute and chair of the ESRB Advisory Scientific Committee, and he will introduce the panelists. So over to you, Professor Beck.
Thank you very much. And of course, first of all, I'd like to follow the tradition introduced just by my co-chair, Steve, and thank the organizers and the ESRB Secretariat for this amazing, highly thought-provoking conference with these many panels. So I will not be able to tell you that the most interesting panel is the last one by intention, but I would like to say that the last panel is the most forward-looking one, because we're going to talk about emerging risks. Now, to put it bluntly, emerging risks are not what they used to be. Now, in the macroprudential community, when we talk about systemic risk, there has been, traditionally, there was a focus on endogenous risks, including credit booms and bust cycles, which, of course, is motivated by the experience of the global financial and the Euro debt crisis. However, over the last 5 years, we've been exposed in the financial sector to a lot of exogenous shocks, of course, starting with the pandemic, but that have affected the financial system through different channels. So we are living in a very volatile world. That's, I'm not telling you anything new. I mean, we are used to trends. Madame Lagarde, the ESRB chair, yesterday talked about opportunities and risks that rapidly developing digital technology presents, including artificial intelligence, topic we discussed this morning. We often talk about the double transition in the EU to net zero and to digitalization, as well as about the demographic transition. And of course, all of these can also affect the financial system. The question is, how they will work out, these trends, how will they play out, and how do they interact with each other? In addition, I would say this still young decade has seen quite a lot of number of shocks. I think Claudia also referred yesterday to the comparison with the 1920s. Starting with the pandemic, the economic fallout from the pandemic, supply chain congestion, and then the horrible Russian aggression, which in turn is part of a larger geopolitical realignment, or you can call it realignment, but maybe also tension, of course. So we are living in a period of polycrisis and heightened uncertainty. There are known unknowns and there are unknown unknowns, although the panelist to my right will later argue that actually he and his team predicted the pandemic, or predicted in 2012 that there would be a pandemic during the next decade, and obviously they were right. Now, given these circumstances, the ESRB has put uncertainty and the role of macroprudential, how macroprudential authorities can react to this uncertainty as one of the work program priorities. And I have the honor of co-chairing a working group, a joint ATC-ASC working group on heightened uncertainty and macroprudential policy. I will not try to pronounce the acronym of that, together with Edouard Vidon from the Banque de France. Now, for me personally, I'm an empirical economist, so I'd like to work with data. Data are, as you know, past. They're the past, they're the present, they're not the future. So for me, this has opened up a whole new world, including horizon scanning, forecasting, foreseeing, forethought, and building scenarios that might not be probable, but plausible. It's less about predicting the future, although we come to that too at some point, but more about possible alternative future that could be plausible, not probable, but plausible. And how can they affect society and economy? And more specifically, from the viewpoint again of the ESRB, is what are the channels through which they affect the real economy and the financial system? Direct, indirect channels. Now, also what I learned during all of these discussions in the working group is that you need diversity. You need diversity of the people involved. And as someone, or alternatively, as someone in this building recently said, we have to look beyond the tribe of economists. And that's exactly what we're going to do in this panel, because I have a very diverse panel. I apologize, I don't have a diverse panel according to the gender, but I have a very diverse panel according to the background, as you're going to see in just a moment when I introduce them. So we're going to discuss emerging risks, trends, including the unknown unknowns, methodologies on how to imagine different futures and how to model them, and then what are the implications for policymakers, including macroprudential authorities. Now, to help me with this exercise, I will start with Ian Goldin, who is the Oxford University Professor of Globalization and Development and the founding director of the Oxford Martin School, the world's leading center for interdisciplinary research into critical global challenges. Now, I think you are only a recent academic, but he has a very long career in the policy world, including as a vice president at the World Bank. Then next, Trevor Maynard. He's not in Oxford, he's in Cambridge, the other big place in the UK. He's the executive director of systemic risk at the Cambridge Center for Risk Studies, located at the Judge Business School at Cambridge University. But his background, he's the mathematician on the panel, and he has a long career in the insurance sector, including risk management and risk modeling, including many years at Lloyd's. Fernando Restoy, I think in this building doesn't really need any introduction, but he has been the chair of the Financial Stability Institute at the BIS since 2017. He has a very long career in central banking, supervision, resolution, including during the Spanish banking crisis. And then finally, Captain Jukka Savolainen is the Director of Community of Interest, Vulnerability and Resilience in the European Center of Excellence for Countering Hybrid Threats, a multinational organization established in Helsinki in 2017, with all 36 EU and NATO states now being members. Before that, he did come in civilian clothes, but he has had a long career in the military, in the Finnish military, both, I think, inside and outside Finland. So, as you can see, again, very diverse panel, very different perspectives. I'm going to start with the first question for Ian. Talking about risks, talking about emerging trends, what are these general trends that we are looking at compared to also maybe traditional risks? And what kind of governance structure do we need, national, but especially in supranational level, to deal with these emerging risks?
Thank you very much, Thorsten. It's a pleasure to be here. And the one great thing about this afternoon is it's the slowest afternoon we'll know for the rest of our lives. The speed of change is accelerating. We're in a complex dynamic system that every second is getting more complex and more dynamic. That's because there are more actors in more places, more consumption, more production, more digital, more virtual and physical transactions. That means the only certainty about the future is uncertainty, surprise. Past data systems are not a good guide, and one of the great trappings of risk management is using the past as a guide to the future. We see that as increasingly blinds us, blinkers us, and so we need to think in new ways with this butterfly defect of globalization, complex dynamic system understanding. It's also about the pace of technological change that we don't understand. I would argue, others have argued very differently, that the global financial crisis was the first manifestation of this. It was because we didn't understand credit derivatives, which were new technological instruments, how they were devised, traded, aggregated, impacted. The kids understood them, that were doing them. I've interviewed many of them, but we in management, in the audit committees, in the central banks, in the global governance institutions didn't managing to do that, even though we could see the weak signals and the credit bubble booming. So we move from a world of connectivity to entanglement. We move from a world of risk to uncertainty. And of course, we move through this in a different economies of growing inequality spatially. The knowledge economy is very different to the manufacturing economy that preceded it. It's in certain places, dynamic places, other places left behind. So the politics is increasingly spatial division, geography that shapes it. This means that some are doing very well, some are doing very badly. The old leaders of our center-right and center-left, discredited along with experts by the financial crisis. I do not believe we would have had President Trump in the White House or Brexit in Britain had it not been for the financial crisis. This has real political implications, and the pandemic exacerbated those. The failure to manage risk leads to anxiety, and that's aggravated by it being very place-specific. No bankers went to jail. Trust collapsed in the system. And that's what we're seeing the implications of: nationalism and politicization, populism. This leads to a downward spiral. an attempt to cocoon ourselves, build higher walls, but we know there's no wall high enough to keep out the great threats we face. But what it does need is the disempowering of global attempts to manage it. So the United Nations has never been weaker, the World Bank has never been less capable, or the IMF in managing the problems we face, not because of these institutions ourselves, where our good friends work and lead, because their shareholders will not allow them to be. You would not want to call the Security Council or the UN Refugee Council or the IMF to solve your problem when you know that its key shareholders do not want it to do that. And so we're in this increasingly divided world. The biggest risk is the growing tension between China and the US, and that, of course, will not change with the US election. So in this, we see only certainty, rising risk, and that places increasing pressure on this organization, on the ECB, on the regulators, to ensure that we are not blinded, that we have the reserves, that we can provide the risk management. We also need to worry very deeply, and this has been mentioned, about the insurance industry and reinsurance industry, because the other certainty is that the pension system, as we know it, is totally unsustainable, and that the accumulation of risks that the insurers face, particularly from climate events, but also other events, will make the reinsurers unviable. This is a highly concentrated, extremely fragile system on which we all depend and which individuals depend for insurance. The way we get out of risk is by insuring ourselves in different ways, and if that system fails, we have a big problem. So I worry increasingly about reinsurance and the insurance industry, pension liabilities and the implications, but also the implications of mega events because of not only pandemics, but also because of climate. Certainly, we will have another pandemic. It could be much worse than COVID-19. We know that because there are more and more people near more and more animals in more places, which near super spreaders. We also know that there are more and more laboratories in the world who are doing sequencing. So accidents are likely to increase in likelihood. From the richest country to the poorest place on earth, that's where the risk comes. Pandemics are different to all other risks because they are global. All other risks, a small number of actors can contain them, and that's the role of this organization because there are a small number of systemically significant institutions. Cyber risk is the other big dimension I worry greatly about because it's very asymmetrical, not only in who the actors are, the ability of small players to disrupt the system, or big countries, but also because the increasing costs of compliance, both necessary and due to regulation, are, I believe, highly disruptive to small businesses. So I'm very concerned about the relationship between the regulatory overload and innovation and small business creation. I think we are stifling small business, but we need to do it. So how do we devise cybersecurity systems and other regulatory systems which don't penalize small businesses, which don't give returns to scale for large businesses and large countries? This is an issue as much for small businesses as it is for small countries, and I think this again is an area where institutions like the ECB, institutions like the ESRB need to be able to provide new perspectives, because otherwise I think we will see a further collapse of productivity, and that of course leads to a further downward spiral. When the cake is limited, political tensions increase, and that's why we already face in Europe, but also in the US, I believe, fractured politics and risk for the future.
Thank you, Ian. So actually, you mentioned already insurance, which gives me a very nice way into asking Trevor, who has worked for many years in insurance, of course, and who has been involved in this risk modeling and the probability modeling and so on. You mentioned the high risks and the high costs. But Trevor, can you tell us a little bit about the kind of methodology if you do forward-looking as a scenario building, given that the known unknowns, unknown unknowns, and so on?
Yes, absolutely. It's a pleasure to be speaking here today. Thank you for inviting me. As you say, my background is sort of pensions industry, life industry, and then general insurance at Lloyd's of London. So I'm not a banker, so I'm sorry if some of my comments are related to those industries, but hopefully we can read across and learn from one another. Systemic risks are very difficult to model. They often cover wide geographical areas and include some or all of the natural environment, physical damages, geopolitics, social effects, economic harm, cyber, and business interruption. Let me start by saying what is wrong. Doing nothing, trying not to model it, is definitely wrong. Zero is not the right answer. And zero, in my experience, is often the approach taken for risks that are too hard to model. We can spend time refining models of risks that we already understand quite well, but neglect to try to model risks that are much harder. At the Centre for Risk Studies, where I'm now based, we're trying to build models covering very challenging subjects, quantifying impacts in the hope that they're useful. We're sure that they are wrong, but we hope they are useful. My career has been in financial services until recently. Qualified as an actuary, worked in pensions, life, general insurance. And when I was at Lloyd's of London, I was responsible for aggregating the modelling of a range of hazards, natural and man-made, including earthquakes, hurricanes, cyberattacks, marine disasters, liability catastrophes, and terrorism. The models used in my experience ranged from statistical models where data is plentiful, through catastrophe models where there is sufficient science and engineering skill to build simple yet credible views of risk, to scenario-based models where knowledge is more nascent. In my view, the catastrophe model is the pinnacle of modeling methods in insurance. Such models take vast data sets of exposure data, which includes geographical locations of risk, building characteristics, and they couple this with scientific models of hazard. For example, a simulated hurricane track and its wind field. They use engineering knowledge to define vulnerability functions, i.e. the amount of damage that a given level of hazard will cause, such as wind speeds of 130 miles an hour cause this amount of damage to that type of property. And finally, such models apply insurance terms and conditions such as deductibles and limits. The great thing about these models is the outputs are geographically coherent. Each simulation is a scenario, and the losses for all policies that are triggered in that scenario are aggregated to calculate reinsurance recoveries, cat bond, and insurance-linked security payouts, and ultimately are used to determine risk pricing and capital requirements. Such models typically include hundreds of thousands of simulations so that the distribution of potential outcomes can be assessed. And this may be the best way to capture aggregate losses from a portfolio of risks. And they're very multidisciplinary, as you heard. But where catastrophe models are available, I would suggest using them in insurance. But for many risks, this modeling is more nascent. And in this case, we advocate the use of scenarios where possible, based on scientific knowledge. But if you don't have that, then expert views. Do your best. Zero is the wrong answer. At the Centre for Risk Studies, we've developed models for physical cyber risk, for solar storms, for deep-tail marine disasters, for pandemics, also many years in advance of COVID, for various forms of terrorism and for civil unrest. These have typically focused on shock scenarios that create an initial hit to GDP or possibly waves of impact over several years, followed by a slow recovery, and based on various resilient levels globally. Our work with Lloyd's of London, which is now my client, not my employer, has suggested systemic effects from extreme weather, leading to food and water price shocks, causing $2 trillion of loss, a cyber scenario implying $3.5 trillion of impact, a global stagnation event, which is $5.2 trillion of economic effect, and even a major volcano causing $1.2 trillion of systemic damage through property damage and supply chain effects. These conditional losses come from a distribution of potential outcomes with varying probabilities. But our systemic risk hub, which is where I'm involved more closely, is now developing longer-term futures, bringing together connected future events to explore the dependency between them. For such futures, we've stopped looking at single subjects, like a pandemic on its own, and ask how these may link together to inform our view of the future. For example, the rise of artificial intelligence with the potential replacement of skilled workers, the wars in Ukraine and Palestine, the global impact of climate change and ecosystem degradation, the spectre of the far right in politics. All of these are happening at the same time. And we feel that for longer-term scenarios, all must be considered as part of a single model. And this requires a multidisciplinary approach that is not typical in academia. If I could have one wish, it would be to see a global effort on the development of coupled social, physical, and economic models using an agent-based framework. We now have the computing capability for this. It would be a grand challenge, it's very hard, but would create a common language that would bring multiple, usually disparate disciplines together. In the meantime, though, I think a structured approach using scenarios to explore a range of coherent futures is the best way forward. So thank you for your interest, and I look forward to the debate in the rest of this session.
Thank you very much, Trevor. Let me turn to Fernando, and now we're going from the broad picture of the challenges for societies and economies more directly to the financial sector. You've heard the picture, right? Doesn't look very rosy. Fernando, how do you see it from the financial sector, and what can we do about it, especially when we look at macroprudential authorities?
Thank you, Thorsten. Thanks the organizers for having me here. It's a real pleasure and honor. It's true. We have heard sort of a list of risks which form part of the environment in which financial institutions actually operate right now, and therefore they are part of the financial stability picture. To some extent, at least some of those risks, or several of those risks that you just mentioned, are factored in the financial stability assessments that many central banks around the globe actually regularly produce. But it's true that if you look at those financial stability reviews, you'll see that in general, sort of the picture that emerges from them is not that sort of obscure, and so it is more of a cautious, I would say, cautious comfort about the current situation. So basically, those reports basically stress that currently, actually, market volatility, risk premium are relatively contained, that banks are in a comfortable capital liquidity position. There are no major or important macro financial imbalances in major jurisdictions. It's true that people show some concern about the course of economic activity, particularly in the context of geopolitical risk. We have been mentioning them quite frequently in this meeting. It's true that now major economies are apparently installed in a sort of soft landing, although it's difficult to exclude the possibility of having inflation more persistent than we in principle expect, or economic activity actually just to deteriorate more significantly, right? But overall, I will say that the picture that emerges from those reports is relatively benign. It's true, though, and this is something which is stressed right now very generally, is that episodes like the unwinding of carry trade positions this summer, this basically shows how rapidly market sentiment can actually change. We know this. And we also know that this is particularly the case situations in which we feel that the financial sector worldwide is subject to important structural vulnerabilities, or is subject to structural developments that could actually make the financial system quite vulnerable. And we have been mentioning some of those structural vulnerabilities in this conference, the technological disruption, different dimensions, the much more complex production processes, more complex value chains, implying significant operational risk. It's about a completely different now competitive landscapes in which traditional financial institutions have to compete actually with new providers or tech providers of financial services, possibility of contagion in traditional financial system of shocks or developments in different crypto environments. So all these things obviously are an important structural development that can eventually sort of increase the vulnerability of the traditional financial sector. Second important element, of course, is non-bank financial institutions. We have been discussing that at depth in this conference. Many issues there have to do basically with the transfer of risk from traditional financial institutions to a segment of the industry whose regulation may not be the most effective to address financial stability risk, and also this important element that the growth of the NBFI sector, or what was the sector was not, was an alternative, spectrum, right? So the growth of this NBFI spectrum implies also the growth of opaque and complex relationships of NBFIs with traditional banks, and this may have actually relevant financial stability implications, right? So this is another important element. And if you go to specific jurisdictions, certainly Europe, there is another structural development I think is very important in any assessment of financial stability, which is the structure of the banking sector, in particular the overcapacity of the banking sector. So overcapacity means lower efficiency, lower profits, and then low market valuations. and you put all these things together, this can only create problems for banks to maintain actually sort of solid solvency positions. So that element is also particularly important. So if you basically take into account these different risk factors with these structural vulnerabilities, also you realize that for a financial crisis, not enough to have an important shock. Financial crisis is a combination of a shock with this structural vulnerabilities, interaction between the conjunctural and the structural developments, which actually create financial crisis. So you think about this environment, I think you have a good motivation just to think how well prepared you are to prevent and eventually to resolve financial crisis. In other words, you have to look at the strength, the effectiveness of your regulatory, supervisory, and resolution framework. And this is actually that now deserves a clear attention. It is deserving a clear attention in many jurisdictions around the globe. If you think about Europe in a nutshell, I will say that we are possibly in a better shape than other jurisdictions in terms of regulation, not least because we apply Basel principles actually to basically all banks in the European Union, although there are some issues about the latest package of the Basel III reforms. If you look at supervision, I think, frankly speaking, as focusing on the banking union, I think, frankly, that the SSM is doing a good job, and particularly now is committed to and strengthening its supervisory processes. I appreciate very much the emphasis on becoming more risk sensitive in particular, and to become more intrusive. I appreciate very much the emphasis put in trying to improve the formulation and the prioritization of qualitative measures, and also to take advantage of the scalability possibilities of those qualitative measures. And this is key, because this type of measure, the qualitative measures, the ones which should normally be more effective to address issues in supervisory areas like governance, like risk management, or business model analysis. Elements which have proven to be extremely important to explain what happened during the banking turmoil, particularly in the US and Switzerland.
Thank you. Fernando?
No, let me say one thing. It's about resolution, which is another important piece, where I cannot be that optimistic, cannot that be a bit. In Europe, the current resolution framework is clearly incomplete, it's clearly imperfect. We don't have a liquidity resolution facility, for instance, at this stage. This has proven essential, for instance, during the crisis of Credit Suisse. And second, we don't have actually effective tools to deal with the crisis of medium-sized banks. There is an important, potentially helpful proposal on the table by the European Commission. The news we received from negotiations in the Council and the Parliament are not particularly positive. There are some counter proposals gaining ground there, which may, in the best case scenario, could actually weaken the proposals by the European Commission, if not completely dismantle them. So this is an issue, an important matter. You talk about actually what should be the policy response. The first one should be that you should actually factor in, you should assume that rather sooner or later you are going to have a crisis. You better be prepared actually to manage it properly. Let me stop here.
Thank you very much, Fernando. So now we can shifting gears quite a lot. Jukka, you work for the Center for Countering Hybrid Threats. And my first question is, it's a very simple question. What are exactly hybrid threats? And can you kind of give some examples that you're currently following? I know you have some slides, and how they play out. And you are allowed to be as optimistic as Ian in your remarks.
Thank you. Optimism is exactly my way of work. And thanks for the question. And yes, these hybrid threats, in the very beginning, we were studying the symptoms of a disease. We were studying meddling in elections, sabotage risk, and blocking sea routes, etc. but now we see that we were really studying symptoms. Then we studied our patients, patient in our conceptual work, which shows the interdependencies in our society in one country by country, Europe and the West altogether. And now we are studying eagerly the disease together with the European Commission's Joint Research Center. And now I'm going to talk about the disease. And US-China, of course, is from the global viewpoint. If you want to create a dichotomy, it's the most crucial one. But I think even if we go to Washington and they look at the globe, then they see Europe, and they see that Europe will have to be facing the problem arising from Russia. So it's very maybe useful to talk about Russia. And yes, the center, it was already introduced, but so we have as members all member states of European Union and all member states of NATO. So I mentioned Russia needs to be explained, so it is, look what they have written, almost nobody has seen. This is Russia's policy toward world's majority. We talk of global majority or global south. They want to say it now, world majority. So this is a published doctrine from the Russian Ministry of Foreign Affairs. You can download if you are not too afraid of Yandex. And here it explains that there is an ongoing and intensifying conflict. There shall be a new democratic world order, meaning democratic. It's not about people, citizens voting. It's about nations being democratically equal to each other, which means in brackets that they are explaining that the West has a colonial past and a past neo-colonial past, and it's been exploiting the rest of the globe in an inhumane way, and now they are going to mend this order. Simultaneously, they explain they are seeking new market space, they are directing their economy to south and east, and they are simply cutting ties with the West. There is cooperation with China, whose investment within BRICS, etc., in global south is actually potentially creating a major market and political community, which also creates a global opposition to what can be called West. This creation seems to, if we look at the Chinese investment in global south and the lacking Western investment in global south, it seems as if there was really a possibility of somebody creating something so big where West is not involved, that we are on the path towards being marginalized. That's big. There are military hazards connected to this challenge, and this is beyond Ukraine. I have to say it very bluntly here and quite publicly, but after Ukraine war, if everything goes as it should go from Russian viewpoint, they will be in the position to challenge United States global hegemony by hitting somewhere in Europe, by taking the best advantages they might be taking at that time when it arrives. So future military problems for Europe certainly ahead. Talking to you now, it's very clear that what we see is we see also an attempt to gradually undermine our political and economical system, and that means a long time gradual undermining. And of course, destabilizing our finance system would work to this end. It would create a temporary incapability of decide something, but also it would undermine the economic in longer run. Now Russia, by the way, seems to be quite okay. If they manage to keep their own control in their own system, they are going to war economy, their citizens don't say anything, and they are on an advancing mode, and they are a raw material producer, but they own all the sources by themselves. Not too bad if you compare to what might have happened to them. You have talked about artificial intelligence, and I just want to point out that these modern technologies, future disruptive technologies, are to come. Nobody can really know what there will be. We need to be prepared of seeing things that we could not forecast, and I think this very beautiful picture is from the desert of Gobi in China. This is one potential avenue that will disrupt many things, because if it's as this might be that a certain type of thermal mirror power stations based on hot sand would be the solution that will change our energy market. And then finally, our very interconnected societies, they can be hit in a very devastating ways. There is a thing called, for example, a cascading power failure, which means we may have really big parts of societies, even regions, without electricity. We have seen many times things that can have been fixed in 1 or 2 days. It can be much longer. I end here. Thank you.
Thank you very much. Thank you very much, Jukka. You didn't disappoint in terms of painting the bleak picture, like all of you, I would say. I want to have a very quick second round about what to do. Where do we go from here? And I'm going to start again with you, Ian. I want to push you a little bit more on the international governance. I mean, you mentioned ECB, the ESRB, you mentioned that, of course, the World Bank, UN, IMF are very weak because of the shareholders or the members that are behind it. What can we specifically do here in Europe in terms of, well, strengthening our role, I mean, also as Jukka mentioned, and kind of addressing these issues?
I think we need to recognize there's no big brother. There's no global institution that's going to look after us. We look after ourselves in our communities. Not necessarily only governments, cities, businesses, etc. Regional groupings, the EU is by far the most sophisticated, advanced of all regional groupings in the world, and it's working. The euro, I've won many great bottles of wine with friends who promised me the euro would collapse in 2010, 2011, 2012. And I'm enjoying that wine. And I will continue to take people on that bet.
I might stop by.
So the issue, I think, is in the term global. We need to think very carefully why we need global. There's only one risk we face, which is global: pandemics. Everything else, a small set of actors can solve 80% of the problem. And that's certainly true of finance. It's true of climate change, where 12 countries account for 80% of emissions. It's true in cyber, where there's a relatively small number of highly sophisticated actors. It's true in most areas we can think of as the risks we're talking about. And so I think we need to build coalitions of the working. The term coalitions of the willing has been discredited, but coalitions of the working, if we can take 10% of the actors to solve 80% of the problem, that's a very good place to start. If we only solve 50% of the problem, that's better than nothing. Let's demonstrate that we can make progress, and by demonstrating that in new ways, I think we will build widening circles of cohesion which come together to do this. And we need to think increasingly about this not just being governments, being regional institutions like the EU or the ECB, but also businesses, cities, and other actors who have a vital role to play, particularly when it comes to things like climate change. Just the states of the US, for example, top 6 states, top 100 businesses account for 80% of US carbon emissions. You know, you don't really need the scale of the actors, and you certainly don't need, and this isn't very politically popular, but you don't need 210 countries at the UN to pass a resolution, A, because you won't get it, and B, because if you do, you're still not going to do anything.
Yeah. Okay, very clear, thank you. So it's again going from the global more to the level that we can actually achieve something good. Trevor, so I want to come back to your modeling part a little bit. So in prudential regulation supervision, both micro and macro, we have something called reverse stress testing, which is basically how big does a shock have to be to wipe out, for example, the equity of a bank or an insurance company. Have you done something like that? I mean, how big does a shock have to be where basically the insurance sector as such, the reinsurers are saying, you know what, sorry, goodbye. Or alternatively, how big does a shock have to be, and like the pandemic, where the government has to come in, where basically the private sector just can't do it. I mean, we often said also during the pandemic, the government is kind of an insurer of last resort. I mean, where did we get to this point? Have you kind of looked into this?
So I haven't done reverse stress testing myself, certainly not at a whole industry level. It is definitely something that you are required to do as part of Solvency II at an individual company level, and I was involved in capital modelling at Lloyd's, looking at that sort of thing. I think To an earlier point about the viability of the industry, actually, because insurance is 1 year at a time, the policies are 1 year at a time, then actually one of the key ways of managing the threat is, and this is obviously not great from a societal perspective, but it is definitely a way that insurers manage risk, is you exclude risks. So if you spot them quickly enough, and if they're changing fast, you can exclude them. Of course, all that does is pass risk back to society. I mean, cyber is an example where I've been working with a number of people, and they are proposing a sort of public-private partnership on cyber. So trying to actually upfront say, this is not insurable. There are elements of cyber, huge. I mean, premium income on cyber is in the billions. So there's a lot of cyber insurance going on, but there are definitely systemic cyber events that are beyond the means of the insurance industry, and this in my view anyway. Interestingly, from our experience, governments don't accept they're the insurer of last resort, even though they clearly are. The pandemic showed that very clearly, and if you look at the size of the pandemic, it was 20% of global GDP in terms of its cost, 10 to 20. That far exceeds the entire reserves and premium income of the insurance industry, so it is uninsurable. So I think, I haven't done the reverse stress testing, but I think anything that stopped insurers being able to exclude systemic risks would be an end game for them.
So it's something when we see that there are certain risks that are just getting got offloaded.
It's much more sensible to have a proper discussion about what is insurable and what isn't, and also get rid of the contract uncertainty that otherwise leaves behind. If you look at the number of court cases in the pandemic about, I thought my business interruption was covered, and it's like, well, no, look at your communicable disease exclusion, it isn't. That's unhelpful to everyone. So I think, that's my comment.
So I think it's an important message. Always read the small print. Although we never do. Yes. Okay. Thank you. Fernando, I want to come back to you, and I want to look beyond Europe. You work in the tower, which is kind of the symbol for global financial cooperation. No, not 210, but 68, 70 or so. And we've heard there are geopolitical tensions are rising. We have a new kind of tension, a kind of pair, China versus the US. To which extent does geopolitics and geopolitical tension, the realignment, affect international regulation, international cooperation among regulators, among supervisors, among other financial sector authorities?
The BIS is in a tower, but it's not an ivory tower.
Yeah.
So that means, of course, we are part of the real world, and the real world affects obviously what we do inside the tower. That's clear, right? So it's true that the spirit of international cooperation actually goes through different cycles, and sometimes actually, like after the great financial crisis, there was a clear agreement actually to try to reform the international regulatory system. And if you think about that, actually the job that was done was quite amazing. We defined substantially prudential regulation, putting in place what we call macroprudential policies, so basically the foundations of institutions like the ESRB, what we did in terms of crisis resolution, even although at a slower pace, there is some more interesting work international regulatory standards also for insurance companies and deposit insurance and so on. So that was part actually momentum that emerged after the great financial crisis, right? What happens now is a different situation, and of course this spirit of the need actually to foster international cooperation is not at the same level as it used to be, and therefore basically the activity or the proactivity of the different international standard setting bodies of course is not the same we had at that time. So the answer is quite obvious. Of course, the political situation, the political momentum obviously affects the production of international standards. That's clear. That said, in what respects cooperation among central banks remains absolutely the same. You have, I'm still amazed to see that every 2 months you have actually governors from all over the world coming to Basel, spending a weekend there, and talking very openly about all relevant issues which have to do with monetary policy, have to do with economic outlook, which have to do with financial stability, etc. So the BIS is an institution whose regular functioning does not suffer much in what respects actually the spirit of getting together and trying actually to get a good understanding of the main challenges in different jurisdictions. What may change because of the political situation, the political cycle, of course, is how this translates into actual policy making. This, of course, may be affected by the situation.
Thank you. Jukka, you painted us the bleak picture, the possible scenarios. They don't look good. May I push you a little bit on what can we do about it? I mean, how it's now looking now from us, from Europe, how can we push back? How can we make that these scenarios don't play out as you kind of describe them?
Thank you very much for this question, because one always gets given a certain time of minutes which one uses to explain the threat. And on the other hand, what we usually don't explain is the weakness of the other side. And yes, they have great weaknesses, and we really can push back. And as I explained, potentially the biggest issue is that geopolitical, geoeconomic competition, which is done in global south. So in order to push back now, we should start planning how we engage countries in global south. Because actually, none of the nations would really like to be put in the China's pockets, because the examples are not encouraging. It's a bad place to be, but of course all sorts of authoritarian regimes benefit from that arrangement. Money without any other conditions but to pay back, or at least the interest. So that would be one. It's a new avenue of thinking for us, because we are very legalistic, and we have, for example, in our engagement with third country nations or new EU member states, potentials, etc., we go very legalistic, and we start talking of rules and regulations that need to be fulfilled in order to deal with us. Now, some more political thinking on that field. The other point of mine would be a little bit more defensive, and it's if we put together, as you know, I'm not from this field, but what I've heard now on bank runs, what we have new technologies, and now that we have these hybrid threats, and as Trevor said, if you see that different disciplines should be brought together, I fully agree, and I think what we have witnessed already in hybrid COE is that we have people who fully understand and work entirely in the field of economics, macroeconomics, plus banking is, as it is more practical, and investment, of course. And then we have people talking of foreign and security politics. And normally these are different people, and their slang is different, so they don't easily talk to each other. And I would see that, talking of Europe now, that of course central bank's role is very clear, and it shouldn't change, I guess, but European Union could have to establish something that we would call economic security intelligence, which would put together these geoeconomic and geopolitical risks, security, military risks, and use people like you in consulting, and people like you in modeling what might happen. So I think these 2 points: outreach, more clever outreach, and economic security intelligence.
Okay, thank you very much. That's clearly an action plan, or 2 action points at least. So now I'm going to open it up for questions from the audience. Also, again, looking a bit at the time limit that we are facing. And I see Javier first, please. You need a microphone. Yes, and then, okay. No. Yeah, the gentleman who's standing.
Thank you very much for all the contributions. I'm going to go in the direction of Thorsten's last questions on what can be done from the community in this audience, which is the macroprudential community. So after hearing about the new threats, it seems to me that one channel through which macroprudential authorities could assess whether we are ready to cope with those threats is our top-down stress testing frameworks. So I wonder that this collection of new threats from this perspective will boil down to adding new sources of shocks, unconventional for us, but basically exogenous in principle to the financial system, to the type of shocks which we hit the system to assess its resilience. Now, I have a potentially optimistic conjecture, which is that given how many liquidity and how big liquidity and capital buffers have been built up to resist other shocks, say conventional shocks, perhaps the capacity of the system to deal with financial disruption, financial losses associated with the new sources of risk might be enough. Maybe I'm too optimistic already on this, no? But perhaps where some of the new risks pose a challenge to the financial system, to the stability of the financial system, is in the operational disruption side. So I wonder whether a line of response, and I want to hear your thoughts about this, will be to make sure whether there are contingency plans or plans B at the level of the institutions, but also at the level of the system to cope with disruptions that could be coming from power outages lasting much longer than normal, or cyber attacks that probably provide, a full blockade of some of our infrastructures. Now, thinking as an economist, infrastructures are a public good. So there is no guarantee that individual financial institutions or agents taking precautions against these emerging risks will care of having infrastructures that are able to resist the new shocks. So I am now, of course, I have no answers. I want to hear your views, whether we should be thinking about how to guarantee payments or how to guarantee funding in emergency situations where the standard channels are operationally failing. And maybe this is a line of thought for the future. Thank you very much.
Thank you very much. If you could pass, Javier, the microphone to the gentleman to the middle in front here. Yes, thank you. Contingency plan, role of government. We're going to come to this in a moment. I'm going to take a couple of questions and then we're going to... Yes,
once again, Dimitri, it was a pleasure to hear both last panels. This question might have been directed to the previous panel, but to this one as well. In view of all of the geopolitical risks that have been and the technological advances that have been emphasized pretty much by the majority of the panelists. For example, the Russian-Ukrainian war, the invasion, has been highlighted a lot. Me as an economist, that I want to use arguments, as my colleague from the other place would say, are models. I read this morning that the BRICS, plus or minus, whatever they call themselves nowadays, have progressed substantially to have an alternative payment system. What would the modeling approach be to the new payment system, and what would the threats to the financial system will be, and financial stability more generally? And given that some of us still believe that there is liquidity, and illiquidity may very quickly degenerate to coordination failures, insolvency, and so on and so forth, is there anything that macroprudential can do to fend off liquidity risks that an alternative or a simultaneously operating payment system might pose to the global financial system?
Thank you very much. So I think there was a question over here, but I'm not sure. No? Yes? Okay. Yes, please. No? Yes, exactly. Thank you.
I think Aine Bunge from the Riksbank in Sweden. I think my question was a little bit similar to the question here, that it was related to what we can do at an institution as the ESRB. And particularly the point is, should we shift the scenarios that we are seeing? Because of course this will also shift the responsibility of risks from perhaps the private sector and the public sector. And I could give an example in Sweden where we're, due to the geopolitical situation, sort of looking at different requirements for operational risks now, looking into scenarios that are not the same that we used before, but that are more based on power outages and other areas. But you think that that is one way forward, and the other part is also in terms of the resilience of the financial system. You said something about structural vulnerabilities and looking into those. How much should the focus be on sort of fixing the things that we know from the financial system and making it resilient to whatever shock that we face, rather than trying to figure out what will be the combination of these new risks stemming from outside risks from the financial system? Thank you.
Thank you. I'll take maybe one more. Yes, do I see Jona there? No? Yes, please, the gentleman there. And then we...
I would like to go back to the speech from Claudia Buch yesterday, where she greatly emphasized the need for cooperation between different macroprudential and microprudential authorities on geopolitical risk. And one thing that I found very interesting was that it only focused on the cooperation between those two kind of entities. And I think we heard like partially from Jukka that also maybe outside of these two entities, also with other actors, be it ministries or maybe private businesses also on, there should be more cooperation. I would like to ask on this, how could this look like? Maybe on the one side in the analysis beforehand, like getting data together to build better models, for instance, for maybe in close to that what we heard from Trevor before, and also on the side of the response, like how could different actors coordinate their response? How do we have contingency plans that don't only look into the micro and microprudential authorities, but have a wider scope of other actors as well?
Thank you very much. So I think this actually goes a little bit back to what Jukka mentioned at the end. So we have planning in the financial, so lots of financial sector questions, but I'm sure that each of you can actually respond to these. I have something to say about these. Contingency plans for certain of these shocks that we've discussed, but also the role of government in terms of ensuring, securing infrastructure. Geopolitical tensions, new payment system, how could that actually influence financial stability? Also, again, new scenarios, addressing structural vulnerabilities, and then the all overarching questions we'd like to keep in our own tribes typically to talk to each other, but how can we overcome that? How can we overcome these, talking from one tower to the next, so to say? I'll go just in the order, and you can pick which questions you want to emphasize, or you want all of them, or you want to answer them in one go. Give it to you. Yeah.
I think the approach does need to be different for a number of reasons. One is what we have is a coincidence of shocks. So imagine a pandemic combined with a financial crisis, combined with a big climate shock in New York, or invasion of Taiwan, or a nuclear event in Europe. These things will not happen separately. They will be codependent, and they will be simultaneous. So I don't think the modeling currently includes codependence in that level. The second big takeaway, I would argue, is that there's been too much focus on capital and liquidity and not enough focus on place. I do a lot of work with banks, and I say to them, where are your assets? Where's your information systems? Where are your servers? Where's your leadership? And it's all in the same building. And this is a building that, if the ocean's 2 meters higher, will be underwater in the basement. Sorry to interrupt, but this was exactly the issue in 9/11. Yeah, remember that?
Exactly.
It was the
23 years ago.
Exactly. It was the issue, but we haven't learned from it.
Yeah.
The place thing, and coming to the government question, I think legislators and regulators should ensure that the advantage of a global institution is that it can spread risk globally. That people place information in different places. That needs to be reflected in credit ratings. It needs to be reflected in, I think, a regulatory response. The resilience of the systems, the energy systems to an electric shock, the cyber systems, the people systems. Imagine everyone in headquarters is out for whatever reason. They have the pandemic, or the building cannot be accessed for whatever reason. Now you want to run it. think about those shocks. And I don't think place has become big enough, and the concentration is actually growing with mergers and acquisitions in terms of people in places, which I think is just an area where we need to see a very different sort of risk offloading happening. So the robustness of this. I'm concerned with our friend Trevor's idea that you basically unload all the risk out of you. You know, the small print takes out all the risk. Because then we get into a whole other dimension of risk, which is governments as the lender of last resort, as the risk taker of last resort, not the reinsurers. But governments, many of them are not capable. Their balance sheets simply will not take them either. And so I think there needs to be also regulation of what can be offloaded and much more risk pricing. One of the bad things that happens in the insurance industry is we're not seeing risk pricing, which is one of the reasons people build homes on the Outer Banks in the US. They do a lot of very adverse, risky things, and they're not paying the price because it's a collective good. So I think that's another area where there can be immense regulatory progress.
Thank you.
Yeah, I mean, just to respond, the risk pricing is actually, we're not allowed to risk price. So that means regulatory change. Yeah, right. I mean, I think building on that, because I think we have very similar opinions, I would develop 3 to 4 different futures. So not scenarios that are short. I would do 10-year futures, and I would put in multiple megatrends into each of them. And I would then bring together all of the relevant stakeholders. So not just talk within the silo of banking. I would do military, different business sectors, emergency responders, NGOs, scientists. And from that, I would think social science, natural science, economics, politics, international relations, history. Get all these people together. So you could develop these futures, and then you could basically run multi-organization scenario exercises. So you could say, and this is I realize this is a lot of effort. It's not easy to do, but then it's sort of saving the planet seems like it's worth it. So I would say you'd start with these events, you would get public responses, but you'd get private responses. Someone would have to get all this information back in and deal with it. You would then feed back out what people have said. You'd have to sort of redact some of it because we want people to be honest. And you keep iterating round and you try and work through this 10 years, these 10 years of history, but in the future. You try and work through that. And you try and genuinely see where these stress points are, because I think we keep being surprised because we keep thinking in terms of history. History can teach us a lot, but also if you think through the future deliberately, then you will see new things arise. So I think you actually could get right ahead of some of these risks, but you'd have to be willing at the end of it to be quite radical in what you did about it, because we do need significant change in society to deal with some of these things. It's not carrying on as we are.
Yeah, I think 20 years ago it was kind of a radical idea that supervisors, central bankers, resolution authorities, and Ministry of Finance would actually kind of play through the failure of a bank. Again, 20 years ago, this was a radical idea, I think. But at least they spoke the same language. So it's going to be challenging, it's ambitious, but I think that's you have a very valid point there. Fernando, I think that goes directly also towards you, no? This question, this point that the Trevor just made.
Let me try to address this question about the role of macro-pru authorities, right? You're right. I mean, basically there is this macro stress test that probably could actually be revisited to see whether we can actually reach sort of the scenarios that typically consider there to introduce those new elements of risk. But you have to be very careful about what your objectives are. If your idea is to seek ways to enhance the resilience, you have obviously to bear in mind that at the very least, this is a joint, actually, sort of objective, together with microprudential authorities. I think Rafa was saying before, macro should actually focus on solvency. It's true, macro should focus on solvency. I'm persuaded by your argument that liquidity issues are somewhat less systemic, although there could be some discussion about that. But it's not only about solvency, it's just macro authorities should intervene to the extent that there is a coordination failure, which is not properly internalized by the microprudential authorities. So we have to be, it's very important, this actually is coordination, adequate distribution of responsibilities between the macro-pru authorities or micro-pru authorities. For instance, if you consider operational risks, materialization of operational risk, then you could consider that unless you identify clear coordination failures, probably microprudential authorities better placed to see how a particular scenario could affect actually a particular institution, on what type of remedies in that particular institution could actually put in force in order to address those issues that have been identified. It's about actually just modifying your internal procedures, your systems, your governance. So there are a number of actions can be taken at a microprudential level. And this is something that should actually be sort of addressed by microprudential authorities, even we are talking about macro type of developments. Actually, this issue about coordination between microprudential and macroprudential authorities is something that which is not yet fully solved. We know that. Even a standard distinction between micro and macro-pru, right? So the macro-pru is about the CCYB, the micro-pru is about Pillar 2 buffers. I mean, it's worse than the Tinbergen world, right? It's not like you have one instrument for two objectives. You have one instrument of objectives and two authorities playing with the same instrument. So do we really have in place actually adequate coordination mechanisms that ensure that actions by macro-pru authorities are not going to neutralize what the micro-pru authorities are doing on the other way? I mean, it's something just we have to look at, particularly in Europe, in which you have this terribly complex framework under which it's not only that we have macro-prudential authorities different to micro-prudential authorities, but also those two different authorities are located in different jurisdictions. So I think something that we should actually review in a forceful way, I would say.
Thank you. Jukka, what can you tell us finance people in terms of how to work better, how to react better?
Thank you. Avoid granularity now. Don't develop your existing system in a more fascinating, but instead invite not just social scientists, etc., also them, but a lot of and enough of real military mindset, because that means it's a people who are ready to reject all the earlier questions and make a new solution. So I would say, for example, the China Communist Party has already set the economic development on stage 2. Stage 1 is the sustaining of the governance, which means maintain the communist system. And that means that leads us to have opponents who can reject the normal understanding of stability and growth as we see it from our point of view of economics. So, and then very good questions. I thank you. And when it comes to Sverige, I would say that this responsibility cannot be shifted. It's everywhere. It's in the private sector because it's about their business continuity and the survival of these companies. It's on the public side, of course, because after all, it's a state's central task is to maintain security and safety of its citizens, the national security. And I see there a certain part of potential growth now for national central banks, because nobody will come to help Sweden or Finland or something if your payment systems is not functioning because there is no electricity. Either you have a solution or you don't have. And for on European level, this has been tackled. There is already critical entities resilience directive given out, and the national governments are now fulfilling it. So it's multi-layers, and but these things should be tested now, I guess, against something more serious than has normally been the case, and that's why you need people like actually for us, because I don't. Not representing a government, but a center where we can take the fool's hat on our head and explain a little bit more rough scenarios than normal people would love to do. So that way, thank you very much.
Thank you, Jukka. We have a few more minutes, but I also have to tell you that Ian will have to get up in about 5 minutes because I think Trevor maybe too. But so let me see whether there are any more questions. I think we were and either we were too pessimistic or, oh yes, please.
Thank you very much for that fascinating discussion. Karen Mansinger from the Senior Resolution Board. I was just listening to the discussion about who we should be getting in the room for those discussions. And, you know, we do scenario planning, And there is a distinct issue with the number of people who are trying to have a conversation. And it scales up very quickly to a point where you're not actually able to talk about solutions because you've gone from a group of people talking with each other to a meeting or a big committee. And so when I hear the discussions about saying, get everybody there, have the interdisciplinary committee, I entirely agree, right? I get what you're talking about. But you're also talking about the need to look at some disruptive solutions, try and find ways of going beyond where we are at the moment, which you usually only get to if people talk to people. So I was just curious how you were thinking about this fact. Is there some way to reduce complexity? And I think Aina was talking a bit about that earlier as well. Do we have to have the master solution, or can we try and bring it back to specific channels which are more focused on solving simpler problems in that context? Because I worry about the big solution just leading to something which is not manageable in terms of the conversation of people trying to actually get to the point about having an impact in terms of making progress. Thank you very much.
Thank you. Ian, I give you the first word. And also, if you have any final remarks, you might just add them there.
Yeah, my apologies for leaving 5 minutes early. I've got a plane to catch. I think this issue of the multiplicity and the paralysis that comes through it, and that's the UN problem in a way, is very real. And I have two sorts of solutions to it. The one is, I don't think that scenarios are particularly helpful because they basically give you a range of optionality and they don't weight them effectively and they paralyze you in terms of what you do because this could happen and that could happen and everything could happen. I prefer more probability-weighted analysis, and I think that can be done through getting experts, so real experts or aggregators of scenarios, people who are able to synthesize it. But I would stick with what Thorsten started with, which is diversity is very important. And that one of the key reasons for the financial crisis was groupthink. Of the people that play golf together once a year at Jackson Hole. And that we need to move against, although it's very nice to go to Jackson Hole. And I think how one gets that in, what skills you bring in and so on, is not by multiplying numbers, but by people that can aggregate and synthesize other sorts of information.
Thank you. Trevor.
I think that if you don't get all of the different stakeholders together, you're going to miss some really interesting connections between risk that you won't otherwise see. And I think it is the connections that lead to systemic risk. So I think I recognize it's difficult, but I think that you can organize well-run workshops with the right representatives there, and you can constrain the discussion and you still can get to a good outcome where you've understood the risk. And on the scenario side, I agree with the probability point. I mean, when we create our futures, we make sure that the items that are in those futures are probabilistically valid. So we aren't trying to do scaremongering. We're trying to put in things that are feasibly likely in the next sort of 10 years. So they should all be samples of the distribution of the future, not extremes that couldn't possibly happen.
Thank you. No.
Nothing interesting to add on this.
Okay. Jukka.
Yes, this would not, in big committees, you would improve the understanding of need of resilience, but the interesting scenarios would lead to highly confidential conclusions. So they need to be done by a smaller circuit of people. For example, if a 20,000-ton ship full of fertilizer, if it detonates just in front of Rotterdam, would this lead to us not having pensions anymore? Would be very sensitive. But somebody should assess it. Thank you.
Thank you, Jukka. So I was hoping to end this panel on a little bit of a more optimistic note, but and I'm not going to try to summarize, and definitely not the bleak scenarios here. But I do think. I mean, we've heard a couple of bleak scenarios, how things can play out, what methodologies are being used to actually kind of model these plausible possible futures. But we ended also on the kind of the note that yes, there are things we can do, not necessarily on the global level, but on a more regional level, which does require diversity, which does require talking to each other beyond this tower, beyond the tower of economists talking to each other. And I think we've got some very interesting ideas, and I'd like to thank Jukka, Fernando, Trevor, Ian for the excellent contribution, and you for the questions. Thank you.